You want it? We have it. The hottest mortgage and real estate strategy broadcast in the nation. A Smarter Way Home with your host, Danielle Boote and Victor Bals. 50 years combined experience, ranked in the top 1% in the nation for home loan originations 2020. Promise to expand your knowledge, utilizing creative mortgage financing and home buying strategies. Build a bridge for a better quality of life. Get your brain cells firing for a smarter way home. And welcome to another episode of A Smarter Way Home. I am Victor Bals, your host, and we are discussing modern mortgage solutions and home buying tips for consumers and real estate professionals alike. And today I want to bring my hostess with the mostest, the gal who's just come back from Vegas, Mrs. Danielle Boote. How are we this morning?
I'm pretty fabulous. A little jet lag, but not so bad.
A little jet lag.
Yeah, 3 days in Vegas. There's a little rebound effect.
A little rebound there. And you talked about wind. You had a windstorm
on Sunday. Yeah, weather was decent overall, but we had this crazy windstorm.
So, but you said it was only in the 70s in Vegas?
It was in the 60s to the 80s. It was kind of swinging.
Wow. Isn't it usually like a billion?
Well, not this time of year.
Okay.
It'll be like 100 soon. They'll probably hit the 90s this week.
Okay.
But even in the 70s, it's nice and you could sit by the pool because the sun is very hot.
Yeah, well, it's hot. It just like the real estate market out there is very, very hot.
Nationwide.
Yes. And we've got inflation going on here. And yesterday, the Feds bumped up the Fed's lending rate by 50 basis points or half a point. And that appears they are trying to curve inflation a bit. And what's your take on that there?
Well, it's important. Inflation is not good for mortgage interest rates. We have been in an not normal, situation, certainly for the past couple of years, with the government trying to prevent the economy from crashing, and now it's time for them to raise. So believe it or not, we could have some short-term gain from the Fed raising the prime lending rate because it'll settle down the rest of the markets. We've talked about it before, but inflation is the enemy of the mortgage bond market, which is what has been causing mortgage rates to go up so drastically this year.
Yes. And
so we'll see. It'll be interesting to see how it settles down in how the markets interpret what the Fed chairman said yesterday.
Right. Well, historically, when the Feds raise that interest rate, and that's, short-term lending, of course, that's on your automobile loans, your home equity lines, your credit cards, because the Feds want to slow down consumer spending. And we actually seen that effect help mortgage rates a little bit yesterday. So, and as the Feds continue to increase these rates throughout 2022, maybe even into 2023, we hope to see some relief on these interest rates here.
Absolutely. Yeah.
So very interesting market here. So, but, so we've compiled this list here of, must-know home buying mortgage statistics for 2022 to maybe give our consumers and some of our real estate professionals a little bit of insight of what's going on out there in the marketplace. And it's always interesting to understand statistics because that's historical. And, of course, if you want to see the future, you got to go back and look at the history a bit.
Absolutely. And the other thing that's important to understand is that it's always evolving and changing. Where we are today is not where we were 5 years ago. And whether you're a buyer or a seller or a real estate agent or just interested in real estate, it's important to understand what's going on so that you can help make yourself an educated decision on whether are you buying, are you selling, are you holding and doing nothing, or just keeping an eye on market conditions. There's a lot of misinformation out there that we hear every single day, and that information in somebody's hands that doesn't understand that it's wrong, they'll make the wrong decision financially.
Absolutely.
Which could have huge consequences.
And I'm also seeing here, because rates are going up, I'm seeing that play on the emotional sense of home buyers.
Yes.
Panic buying. I gotta buy before rates go up. That may not be a very good move at all. When buying a home is a big investment, and you don't want to hesitate or panic buy.
Well, I find that I agree with you. You should not panic buy. And I think consumers, potential buyers, are more concerned about the increase in the price of the home than they are interest rates. Now, nobody loves the higher interest rates, right? But we know historically that where we are today is lower than the national average for the last 50 years.
Yeah.
So rates are still relatively low. They're not affecting the affordability index for most consumers. But what I think people are panic buying over is the, 15 to 20 plus % increase in property values.
Absolutely.
Year over year, the past couple of years.
Because
you can't make up. Most buyers cannot make that up. The other factor is that anybody that does have a house to sell is selling it generally for so much more than they ever thought possible that it's giving them a lot of flexibility to be able to spend more.
Absolutely.
Because they have the money. It's not that they're borrowing necessarily more. I think we're seeing, in many cases, people with stronger down payments, don't you? 20%. Now it's sometimes we will get people that go, oh, no, I'm putting 25 or 30% down, and they still have money left over from the sale of their property.
Right. We had a guest, Heather Mahone from Keller Williams Living here in Brighton, Michigan, just a couple of weeks ago, and she actually brought up a very good point because of so many home buyers getting kicked to the curb with the government type offers, or only those who have enough funds for the down payment, closing cost, and setting up their tax escrows, and don't have any extra money for appraisal guarantees, paying over asking price. And her advice was, maybe they should wait, and you need to save that money or look at other resources if you're going to compete out there in the market.
Now, I don't know how much you follow on Facebook. There are a couple of local real estate chat groups with real estate agents and some professionals. And the chatter in the past week in Livingston County that has come out, agents are asking and saying, look, my houses are not getting as many showings. They're still getting multiple offers, but it seems like we're in a little bit of a shift here. And maybe the higher interest rates have had a few buyers stop looking, or maybe the buyers that aren't really qualified or seriously looking are slowing back, which might take a little bit of pressure off the market.
Yeah, and I've told clients, higher interest rates actually may be a good thing for you.
Correct.
Because it is taking a lot of home buyers, the ones that aren't prepared, that have the extra money, the lower credit scores, it's actually taking them out of the mix for competition. So this could be a good opportunity for you, because we know historically with interest rates, what goes up must come down.
Exactly.
So if we need to position you and you are in a higher interest rate environment, maybe we utilize that as a Band-Aid until, and get you home ownership until we can put the stitches in, and we will give you, when and if rates come down, we will take advantage of that opportunity and reposition you, well, I guess.
When you look at real estate, okay, yes, you're buying a home for yourself and your family, but it is your biggest asset and probably your biggest liability. So on average in America, most consumers do not stay in a mortgage more than 5 years. Think about that. If you get a 30-year fixed rate mortgage and you don't stay in it for more than 5 years, it could be multiple reasons. You could move, you could refinance, right? All of these things come into play. But as a homeowner, you should manage your mortgage just like you would any other asset. The mortgage is the leverage for you to buy real estate, because most of us don't have that much cash to go out and buy and pay cash for a house. Okay.
Right.
It's not any different. Think of it this way. If you have money in a 401k or in an IRA, if you start investing in your 20s or 30s and don't look at that account for 40 years, do you think that you're going to retire the way you hoped? Are you just going to get lucky and pick the right funds that are going to get you, 18% appreciation over the next 40 years, and you're going to retire like, a king and a queen. No, you are going to manage that 401k. If you're wise, you'll get your financial advisor to help you manage that money, even if it's not under their control. So you should manage your mortgage, which is the leverage against your largest asset, and make sure that you're in the best possible position. So yes, we will see rates fall probably in the next 18 to 24 months when we hit a recession and the economy does slow down. But if you purchase a house today, even at a slightly higher interest rate, it's, again, still lower than average, you're going to be in a great position. Then we'll be refinancing people again to lower their payment, to remove PMI, and again, put them in the best position possible. How many people in the last 2 years did we take from 30-year mortgages with PMI to shorter term mortgages?
Yep, and lower rates.
And lower rates, shorter term, and in some cases, they kept the same payment. They lowered the payment. I mean, people did smart things in the last couple of years that took advantage of it. So if you can't look at this and go, well, if the rates are 5.5, I'm never going to see a lower rate again. Well, no, that's not probably the case. I don't think we're going to see the interest rates as high as we did in the 80s. And when you look at it from a perspective, the last time we saw inflation this high, what were interest rates?
Yeah, 18%.
Yeah, they were from 12 to 18% in the 1980s.
Yep.
So we're at, 8.5% interest, inflation rates, above 8% inflation. And we've got interest rates in the 5.5% range.
Well, but remember, and when the prime rate or the federal fund rate go back to the 80s, I remember where you could get 10, 12% on a CD on your bank accounts.
Yep.
Right now we're getting next to nothing?
Nothing.
So as they raise rates and the Fed raise these rates, well, hey, bank accounts are going to come back there too. Yep. But I want to touch on a point. You said, a house is like, you got to manage your 401k. House is like buying a 401k. And me, through my history, I've always used a 401k as a last resort, as a retirement account. Well, of course, It isn't a retirement account, but I mean an emergency account, right? Not that we want to touch it, but it's there if we do touch it.
Yep, you could take a loan against it.
In many cases, we have home buyers that will dip into their 401k, not to go buy lottery tickets or go to Vegas and put everything on red, but to take that money and utilize to buy a home purchase. And many times I know many borrowers who actually use a 401k loan to, get out of debt or some life-changing event. And so when we look into buying home ownership or creating, I guess, another type of retirement fund like a 401k, over time, that home becomes an emergency account because I don't know anybody where life doesn't catch up with college, something's broken on the house, I need a new roof, we've got some life-changing event, a job change, where they don't take cash out of that house because they own a home and they've got that appreciation to hit that reset button. And boy, if they didn't have a home and they were renting, they would be forced to take it out of their retirement account or 401k if they had it, and they can't replenish that. Right.
One of the other things that we're seeing in this market that's challenging for older, many cases retired borrowers, is their house is free and clear. Mm-hmm. They're retired, and now they want to downsize. Okay? And you have a borrower with excellent credit. They might have some assets, but they basically want to pay cash for their condo or whatever they're downsizing to, but they're not liquid. Right. And guess what? At this stage in life, if all they've got is Social Security and a moderate or small pension, they might not qualify unless they have a sizable asset base. Right. And everyone's lending criteria is different. So, you may go to a bank and go, okay, can I get a home equity line of credit? They're not going to give it to you potentially at that age. Right. Not an age issue, but with that income scenario, because they're just going to look at it very black and white. And you go, okay, well, that's great that your house is free and clear, but now you want to do something and you're not in a position to pay cash unless you sell that asset.
Absolutely.
So maintaining liquidity is very important. And again, I'm not about overborrowing, okay? Not about that at all. But you go as a homeowner, you need to plan and prepare and again, look at the big picture. It kind of goes back to, we have a lot of people that go, well, what about a 15-year mortgage? What about a 20-year mortgage versus a 30? Well, they can all be good options for the right reasons, but they also can be a very bad option.
Double-edged sword there.
For the wrong reasons. And I would rather see, one of the things that I tell my clients frequently is, what is the definition of financial freedom? Mm-hmm. Is it truly having no debt whatsoever? Or is it being in a position that you have the liquidity? Okay, let's say you want to pay your mortgage off in 15 years. I would rather teach a consumer how to save money outside of the mortgage, especially if they have a very low interest rate, and be able to write a check to pay off that mortgage in 15 years. Yep. Because then your money is working twice for you. Your property is still appreciating. You're getting a tax deduction for whatever mortgage you have, but the money that you're saving to pay off that mortgage should be working for you
in the market
somewhere to make more money. So you actually could pay your house off sooner if you keep the money outside of the mortgage. And then you also are creating true financial independence because you have enough money set aside that if anything happens in life, any speed bump comes along, the roof needs to be replaced, financial tragedy occurs, somebody passes away unexpectedly, you can handle it. Someone that is retired, that has not a lot of assets that they can draw from, and has a property that is owned free and clear, they're handcuffed.
Yep.
They're absolutely handcuffed and cannot do what they want to do. And I get referrals right now every week from people in that situation. People that you go, well, they really don't, they don't want a mortgage, and B, they really can't qualify for a mortgage. They're going to have to sell and then be patient to buy, which, we're talking people in their 70s and 80s that are really not wanting to do that.
And that takes them out of the competition pool because in this particular market, it is very difficult to get an offer accepted contingent upon you selling your home. And going back to the point you made with the people fixed income, maybe retired, always a good rule of thumb is as you're going to enter within 5 years of retirement, or when you think you're making your last move on a mortgage, or if it's getting near paid off and you're still working, go get a home equity line of credit because that's like money in the bank, and you can tap that for those life-changing circumstances.
Right. And then you pay it right off when you sell your house.
Yes.
But at least you've prepared. But so many people don't prepare. And and that conversation matters regardless of what age you are. It's important when you're younger. It's important when you're in, your 40s and 50s and raising a family. And it's even more important as you age, because what are you going to do with that property? And there's also, and this would be more of a conversation for a financial advisor, but there's big things you got to be concerned about: Medicare, Medicaid, potential unexpected healthcare costs. I mean, look at what you just went through with your dad in the last 2 years. I mean, it was tremendous. And we're going through the same thing with our family with aging parents. And you go, there's so many things to consider, as you age, but liquidity and being flexible financially, that's true independence. Not just saying, I have no debt. Well, if you have no debt and no money in the bank, that is not financial independence.
Right.
That could be foolishness.
You brought up a real good point here, because these are conversations that should be, to me, at the dinner table,
right,
with your spouse, if you have one, discussing the mortgage and all that. I mean, people go to the dentist twice a year. They go to the doctor once a year. They talk to their financial planner once a year. A conversation with their loan officer is a very good conversation to have once or twice a year,
right,
just to keep updated on life's event, what's going on in their life, what's going on in the market, just to kind of get a temperature of what's going on.
So let's talk about what and who a loan officer is. Okay. Because that I find is a huge misconception. Okay. You and I work for an independent mortgage banking company. We are licensed federally as well as have a designation of a certified mortgage advisor that we worked very hard for and have to do ongoing education to stay sharp in the market. If, depending on who you're talking to, okay, you can go to a bank for a mortgage, you can go to a credit union for a mortgage. Those individuals are not licensed if they work for a federally chartered institution.
They fall under the umbrella or the license of the institution.
Correct. And they basically are just an order taker. Okay.
Yep, they're opening up savings accounts, bank accounts and that, and also they're advising on the most important investment in your life.
But they're not advising.
Right. Well,
they're just putting you into a box. You either fit or you don't.
Right.
And if they don't know how to understand your financial situation, you're probably not going to get a loan from them, even if you're highly qualified. And we've talked about, for instance, the self-employed challenges. Self-employed people can have a lot of challenges, and many self-employed borrowers we see today have multiple businesses, okay? You take a retired borrower who, again, has sometimes a detailed financial situation, and it's not cut and dry at that point in their life either, that isn't going to fit into the square box. You're not dealing, I wish that there were different terms. I wish that we didn't use the word loan officer across the board.
Yeah.
Because, it's like buying a car.
Right.
I mean, the difference between a good salesperson at a car dealership versus somebody that doesn't know what they're doing,
It's like attorneys, what do they call an attorney who passed the bar by one question? An attorney.
Yeah.
Right?
Yeah.
And how I look at a banking institution, they could have been selling ice cream yesterday.
Yeah.
And now today they're dealing with the most, important financial decision of your life. And generally, on those type of institutions, they have one flavor, and that's vanilla.
Correct.
A mortgage banker, a certified mortgage advisor, we're more like 31 flavors.
Yes.
Because when that retired individual that comes in, and you've had a situation like that, they don't qualify at that bank, but you just used a common tool that we use that is very creative called asset depletion to create an income stream for that individual, and there's just so many things that need to be looked at.
Correct. And I think if it were all as easy as just going to the vending machine and putting a buck in and pressing your number and your letter, and then your house falls out, that's the problem, and that's where people get, there's a lot of misconceptions in the market. And right now, we're talking about trends for 2022. Yeah. We are seeing large layoffs from big mortgage companies nationwide.
Yep.
Okay. So as an example, I'm not going to name names, but servicing companies, the company that you make your mortgage payment to, they don't usually originate mortgages. They've started doing that in the last couple of years just to retain the people that they've got in their servicing portfolio. Those companies are contracting right now by hundreds and thousands of employees. Other large Detroit-based nationwide lending companies, 2,000 employees laying off. There are some companies that aren't. I'm not saying everybody is, but when you look at it, you go, okay, this is the people. Some of the people getting laid off are the people that were the phone jockeys. The order takers,
yep. And those were the big refinance houses taking advantage of the lower rates. They come and go.
Correct.
Correct.
Yeah. So it's not just about the rate. Consumers can choose to believe whatever they want to believe. It's not just about the rate. It's not just about the closing costs, because you can get really bad advice from those order takers that have the title of mortgage consultant or loan officer. I mean, there is actually an NMLS consumer site nationwide that any consumer can go to and check a loan officer's mortgage license. Even if they work for a federally chartered institution, they will have an NMLS number. They're not licensed, which means they've never taken the class and they have never passed the federal exams.
Or the continued education that has to
Correct.
happen every year.
Correct. So you can see people that were doing other things 6 months ago.
Yeah, it's it goes back to that conversation with the consumers. I see many consumers. Oh, I hear rates are down or rates are up. Let's go get a mortgage. Right, and just jump on that train.
Yeah.
Pick up the phone and call maybe one of the big institutions because they advertise the most.
Right.
And just potentially get some really, really bad advice.
Exactly.
And they're not doing their homework up front.
Exactly. So let's dive into some of the statistics that we are seeing out there right now that we think will be interesting for consumers.
Well, and let's talk about the average U.S. home buyer. Danielle, what are just some of the general stats we could talk about here?
Well, the stats we've got here are from the National Association of Realtors as of 2021. The average U.S. home buyer, 62% are married couples, 18% are single females, 9% are single males.
Wait a minute. So we have double the females
Absolutely.
are being homeowners than men.
Yes.
What do you think is going on behind that? I have no clue why that.
I think women are extremely motivated.
Yeah.
And I think that, despite, there's always a lot of conversation about income disparity, okay, between men and women. But I have seen a huge uptick in the last 10 to 15 years. Women are very powerful income earners. They're very motivated, and many times they're single parents. So, they want to provide a home for their family. It also is socially acceptable for a woman to now buy a house versus 40 years ago, okay? In the 1980s, let's put it this way. 40 years sounds like a long time, but if we say 1980s, it doesn't quite seem that long ago.
Yeah.
For some of us, I hate to say.
Because that 40 years is almost a half a century.
It is. But 35 to 40 years ago, it was not acceptable socially for a woman to buy a house.
Right.
And I had a realtor that we both know. She told me recently that she tried to buy a house by herself in 1980 as a single female and with a good job at the time. And the bank told her to come back when she had a husband.
Really?
Yes. So she paid cash for the home she bought.
Wow.
By herself. Honestly, I see that single females can have strong credit. They can have much stronger credit than their male counterparts. And they're very educated financially.
Absolutely.
Okay. So that's definitely been a very strong trend. In fact, my oldest daughter bought her first house all by herself.
Back in I think it was 1976, the Equal Opportunity Credit Act, right?
Yep.
It's where husband and wife would go in and get a mortgage, and they would turn them down because they looked at the age and they said that the wife was of childbearing age, and they did not want to use her income. And that's where the Equal Credit Opportunity Act came from, because that was basically discrimination.
So even in the early 90s, discrimination would occur in lending against women that, for instance, might have been on maternity leave. They would assume that a woman on maternity leave, and even if she was getting short-term disability or something of that nature, or getting paid, there are some companies that pay people when they're on maternity leave. We couldn't use her income until she was back to work. And that from a lending statistic or from a lending aspect has changed. But there's a lot of, here's the thing with single females. You could have a single female that has a partner of some nature, but they're not married, but she's stronger financially than her counterpart, and she's buying the house.
Well, and as we look at the statistic here, unmarried couples, 9% of all the purchases are unmarried couples. And just to let everybody know, just because you're unmarried, both can still go on the application. there, and we can use both incomes, and we do that quite a bit, actually.
Yes, yeah.
You know,
And then 2% other. I'm not sure what other would be, but 2%.
I don't know.
Maybe businesses. I mean, it could be a business. I don't know.
Be investors.
Investors, maybe.
You know?
Yeah.
But I know that 21% of all home sales right now in this first quarter of 2022, 21% is investors buying homes.
It's huge.
Taking a lot of the inventory out of these first-time home buyers and these second-time home buyers out there. So the median homeowner salary in the United States is $72,615, and renters' median salary is $35,000. When looking at home prices and income, 82% of homes are affordable for the median income. Kind of interesting there as well. Let me see here.
First-time buyers made up 31% of all home buyers in 2021.
I got to agree with that, because when I look at the clients I'm working with right now, all the pre-approved clients I have, it's 30. I would say I'm about 35 to 37%.
I think that's going to go higher the next couple of years, which is the really important thing to understand with this market. Okay, if we have such a great population of young adults in their late 20s to early 30s that want to be home buyers, they don't have a house to sell, and they need to buy regardless. You know, I bought my first house at 10.5% because that sounded like a good number. Her hearing that in the 80s it was 12 to 18%, and we were just happy to have a house. But we were like, well, 10.5 I guess doesn't sound bad. Yeah. You know, if we were at 7.5%. And rates come down to 5.5%, people are going to think 5.5 is a great rate.
Yeah. Oh, absolutely. Yeah. And you're not buying a home because of rate conscious. You're buying a home because of objective conscious.
Right.
And
don't,
I guess, worry about the things you can't control. Get with a loan officer that understands the process, and just get the best product available in current market conditions.
Yep.
As market conditions change, have that conversation.
Right.
To see if you could better your position.
Right. So 31% of all home buyers felt that they made no compromises in the purchase of their new home. The top reported compromises were price, condition, and size of the home.
Wait a minute. So 31% felt they did not compromise, which means that 69% felt they did compromise.
Right.
Because of the market
conditions, right? Which maybe means they're buying a smaller house or not as big of a
it
yard
didn't have
as they wanted.
All the bedrooms, or
it had wallpaper still that they were going to have to take
down. It had
down.
the Bobby Brady basement, if you remember that.
Yes.
So
yep.
Yeah, the drop ceiling.
And when looking at prior living arrangements, 37% of all buyers rented an apartment or house before purchasing.
Wow. 51% of all buyers found their home through the internet, and 28% used a real estate agent, and that comes from the National Association of Realtors. That's pretty interesting. And a majority, 56% of Americans who previously worked with a real estate agent cite excellent customer service skills as one of the most important qualities for an agent to possess. That excellent customer service skills were defined as kept in touch, followed up, explained things well, and made themselves readily available. And we know that. We're in sales. You gotta
be
pick
available.
up that phone.
Yep. Home buyers also, home buyers who have children under the age of 18 living in the home accounted for 33% of all buyers. And when looking at buyers between 31 and 40, which is that hot millennial market, 61% reported having at least one child under 18 living in the home.
Wow.
So it always has been and always will be,
97% of buyers reported using an online website for information regarding their home search, and 87% reported using a real estate agent. So everybody is going online. So,
and here's another interesting statistic. Buyers between the ages of 40 and 54 have the highest household income of any generation at $113,300 in 2021. And we know that wage scale is going up. And that is so important because everybody keeps going, well, they're overbuying. They're not.
Well, this supports your statements of these people can't afford homes. You know, they're only using one of the couple's income. They have the money.
Right.
And this is what is creating that competition out there because we have.
They're not spending 30+% of their housing, their income on their housing expense. They're spending 20 to 24%, which gives them a lot of wiggle room. And nobody, people don't understand that. No, if you're working at a fast food counter, you are probably not in that bucket unless you're managing or something of that nature.
But these people are readily. They're objective conscious,
Correct.
not rate conscious,
Correct.
and they're out on that playing field knowing how to execute an offer.
Mm-hmm.
Very interesting. The average showing index for a single home in December increased from the index the previous year, and I actually don't even understand that. But the showing times are going down dramatically. Homes used to be on the market for sometimes 30 days, but now they're on for 2-3 days.
Yeah.
You got them coming soon on Wednesday. On Friday, they start the open houses, and it's
pending by Monday.
Yeah. They don't even have the agent doesn't even have time to get the sign out on the lawn there. It's just very interesting. Buyers who called a real estate agent searched on their own for 3 weeks before calling an agent. Kind of an interesting statistic there too. So people are trying to self-educate. What's your thoughts on that?
I absolutely think that is the case because we see it, right? When people go, okay, I found the house and I'm in love with it and I need a pre-approval and they're not prepared.
But
I also think that this is an important statistic because I do think it shows how many buyers are out there that are looking, whether it's in-person showings or online. We can see it with the Zillow views, right? When a house goes on the market, there could be 500 Zillow views or 1,000 Zillow views or more on a particular property.
Yep.
But how many showings are there and how many offers are there going to be then on the property? People are looking, and I think realtors, there's still I think a huge percentage of realtors that are showing homes to people without pre-approval letters.
Well, and I was just going to touch on that because you always make that point because we're seeing, I guess, rates are up, so we're seeing less offers on a house or less showings. That coincides with this. Take that over, Danielle, about being pre-approved versus they're just tire kickers.
Well, what a tire kicker is somebody that has not talked to a lender, has not given their financial or credit information to anybody to see if they're really approvable. And because of the tightness in the market, okay, meaning there's not enough, there's more buyers than there are houses, there are some realtors that aren't making money, are struggling right now, and they're going to show anybody a house if they can potentially get them interested in one. And then they're going to start showing them houses and then go, well, how about a lender? Do you got a pre-approval? So, you might have 10 showings on a house, but what is the percentage that those are serious buyers versus tire kickers or somebody that's pre-approved? Now, it's not uncommon in higher price listings, $1 million plus market, where the buyers got to prove that they're approved for a loan before they even see the house.
Well, this goes to say because a lot of previous homeowners, they're out there looking again. They've got a mortgage. They were well qualified before, and the agents will just say, "Oh well, I've done his thing before. He's solid. He's gold. Don't worry about it."
Not always.
Yeah, not always. And even so, they may just say, well, I'll get it once I find a house. Once they find that house, and by the time they get a pre-approval, submit all the documentation so that lender has a very solid, well-documented pre-approval, it may be too late.
Exactly. So here's another interesting statistic. In the first quarter of 2020, the homeownership rate was highest for those ages 65 years and over. 78.7% of those 65 and over were homeowners. The lowest homeownership rates were for those under 35. 37.3%. Okay. And we know that that's the hottest
market
are those first-time home buyers. So there's a ton of growth potential for this generation to become homeowners if they can find houses.
Wow. Moving on here, another statistic. Millennials made up the largest share of home buyers in 2020 at 37%. That is interesting here.
Mm-hmm.
That millennials, let me see here, 58% of people under the age of 30 rented before purchasing a home. For those ages 31 to 40, 50% rented before purchasing a home. Very interesting here. Wow. 7.1 million homeowners went into forbearance during the COVID-19 pandemic. Well, we kind of see that going by the wayside. And I don't think, and of those 7.1 million, I would say the majority of them are not going to lose their home to foreclosure because they have so much equity and the lenders are working with them there.
So let's talk a little bit about houses and what buyers are saying. So in 2021, the typical home purchase was built in 1993 with 3 bedrooms, 2 bathrooms, and 1,900 square feet.
3 bedroom, 2 bath, and
1,900 square
I
feet.
remember back in '86, it was 3 bedroom, 1 bath, and a garage.
Yeah.
In a basement. Yeah.
Well, really, when you think about the smaller size homes, for instance, in the Detroit market, Livonia, Redford, Farmington.
Those are all 1,000-footers.
Correct, but those were built in the 50s and 60s.
Yeah. Did you know, when you go into a home, talking about older Livonia homes and stuff like that, remember the cove ceilings?
Yes.
All the that was wet plaster.
Yep.
So, when you walk into a home, if you see the cove ceilings, that means it was built before 1959 because in 1960, drywall came out.
Yeah.
Little stat for you.
There you go. So the 2 most desired home features across generations are a primary bedroom with a bathroom. Oh, the notes are cut off here.
Yep. And you think that's with first floor bathroom, first floor master? That seems to be very popular.
It is right now. Yeah, but certainly that's hard to find. Also, carpeting is less popular among all generations. Only 20% of millennials like carpet. 21% of Gen X and 21% of boomers saying that carpeting would make them more likely to purchase a home.
Yeah.
So the buyers love hardwood floors, the vinyl plank, all of those things.
It was
easier
funny.
to keep clean.
When I bought my home in Warren back in 1986, it was carpet and that, and we went in the paint when we bought the home and we tore up the carpet, and what's there? Hardwood floors.
They covered them all up in the 70s.
So we sanded them and stained them, and it looked good. And back then, it was gray and mauve were the colors, and gray is still in.
Yeah.
So very interesting.
And here's another interesting stat. Respondents between 55 and 64 years of age were the most likely to purchase 1 or more investment properties. So 11%.
Very interesting.
Of that age group has some kind of investment property. Let's talk about new versus previously owned homes.
Oh, yeah.
New home purchases made up a 15%
This is new
share.
construction.
New construction. 15% share of all home sales, and previously owned homes made up 85%.
85, so still 15%.
There's not enough home. Yeah. If there were more new builds, that number would be higher.
Yeah.
I think historically that's very low. And the top 3 reasons reported in favor of purchasing a new home include avoiding renovations, the ability to customize, and amenities of new home communities.
Wow.
That's for purchasing a new home. The top, let me rephrase that. Top 3 reasons reported in favor of purchasing a new home. There's the top 3 reasons in favor of purchasing a previously owned home include better value, better overall price, more charm or character.
Wow. The median asking price between April and June of 2021 nationally was $238,600. When we talk about our county, I think just in April we are at about $339,000 median home price in Livingston County. And when I bought my first home out here in Livingston County, it was $138,000, right? And now I just had a client put an offer in on a home in that same neighborhood, $390,000.
Wow.
I couldn't believe it.
Yeah.
But it's still a beautiful neighborhood, and it's more affordable today at $390,000 than what I had in 1998.
Yeah, so let's talk about home size, which is
Yeah.
always important. Roughly 7 in 10 millennials and Gen Xers said they would be willing to sacrifice the home size for a move-in ready home. Boomers agree, but at a lower rate. So the boomers are at 63%. Okay. So that older generation is willing to look at a home and go, okay, we'll fix this up because they have the asset base.
So they have the assets,
younger
and they have no social life.
Right.
There's nothing else to do.
Exactly. So as a home seller, that's important to know.
Yeah.
Because if you do the right home improvements and keep your home updated, it means you will have a greater return on your investment.
So the baby boomers who don't mind older stuff that needs some improvements, they're in a better position if they sell to make it sweet because they're going to get top dollar from the millennials.
Yep. And then we already talked about, but the typical home purchased in 21 had 3 bedrooms, 2 bathrooms, 1,900 square feet, and was built in 1993.
Wow.
The buyers aged 41 to 55 purchased the largest medium home size at 2,100 square feet.
Because they're the ones with the kids.
Yeah, and they have more assets. Buyers 30 and younger bought the smallest properties with an average size of 1,650 square feet.
They just want to get in, get their feet wet, get in the home ownership, get that tax break, and get that appreciation clock going.
Now, here's another important factor. Neighborhood quality, job convenience, and affordability were top factors that influenced the neighborhood choice.
Okay. And now we see a lot of people, since the pandemic, it's just kind of normal to kind of work from home.
Yeah, a lot of people.
I had a conversation with a client yesterday, and they just put an offer in. This gentleman, they put an offer in Saline, and he works at the General Motors Tech Center. And that's a 80-mile drive, 80-mile drive. And I go, I thought you were moving the South Line. He goes, well, my wife's seen this house in Saline, and she works in Ann Arbor. She goes to Ann Arbor. He goes, but I only go into the office one day a week, so it makes sense for us to move out that far because it's more convenient for the wife, and I work from home.
Wow.
So very interesting. Hoping to hear back on that offer today.
Yeah, so here's some interesting statistics on the metro areas with the highest gain in housing prices. Boise, Idaho. Went up 28%. And Austin, Texas went up 23%.
Wow. Boise, Idaho.
Boise, Idaho.
What do they got in Idaho and Boise?
Well, you know what? When I was in Vegas this week, I ran into one of the managers from Washington, and I think he moved back to Idaho. Wow. So people are leaving. And I'm not going to discuss Washington State, but there's a lot going on there that, let's call it, not family friendly. Think about everything that's gone on there in the last 2 years. So housing is more affordable. I think the tax base is lower. And if you're working remotely, you will leave where you don't want to be to go to where you want to be. Nearly 3 out of 4 boomers, 72%, Gen Xers at 73%, and millennials at 73% want to live close to their families.
Oh, we see a lot of that here. Why are you moving? Why are you leaving Florida to come to Michigan? I want to be with family.
Yep.
I want to be closer to family.
Yep. Vacancy rates in top choice urban neighborhoods sat at 9.6% in the first quarter of 2021.
Why would we have vacancy rates when we have not enough housing? What do you think backs that? Is that because maybe these are second homes or something?
Top choice urban neighborhoods, that makes me think of Chicago.
Okay.
Detroit, New York, very expensive areas to live, and it's not necessarily desirable for the general population. Think about Detroit, right?
Okay. Yeah.
They've had a little renaissance in some of those downtown areas, but they're mostly condos.
Right.
That would be good for single people. It's not going to be good for the general population or the aging population.
Well, I would say here in our county, we don't have much of a vacancy rate.
No,
now,
not at all.
if they're second homes and stuff like that, or lake houses that are second homes, are those considered vacancies?
I wouldn't think so. I wouldn't think so.
Very interesting. Wow. Well, what else do we got here, Danielle? We're about wrapping this up.
Well, let's talk senior specific preferences. Senior related housing was purchased at a share of 9% by buyers between the ages of 56 and 65, 18% by buyers aged 66 to 74.
Wait a minute. So what is this saying now?
9% of all buyers were between ages 56 and 65.
Okay.
18% were 66 to 74.
Wait a minute. So we've got more people.
Wait, let me finish.
Okay.
And 20% of senior buyers were between 75 and 95.
Between 75 and 95.
Yes.
You think this is the downsizing?
Yes, and people living longer.
Yeah.
Okay. If, let's think about that. 30, 40 years ago, how many people did we know lived to be 100?
Not many.
And if they're between 70, 75 is kind of young in my book, 95 and they're thinking of moving,
Yeah.
maybe they're slowing down, downsizing, whatever, but they must be in fairly decent shape.
Yeah, I gave I gave an 84-year-old man a 30-year mortgage, and people say you can do that.
Yeah, we can't discriminate.
We can't discriminate against age. No problem at all.
When looking at neighborhood choices, seniors age 65 and up reported the quality of the neighborhood to be the most important.
I can see that. Yeah.
Some buyers ages 66 to 74 reported that they are living in their forever home and would never move. 34% say they will not move from wherever they are, while 25% reported that they would move for a household member's health.
Okay, well, that kind of makes sense, too.
But 34% of that baby boomer generation
I'm not
is
going anywhere.
Huge.
You're burying me in the backyard.
Right. But they're living in bigger homes generally.
Right, yeah.
Right?
Yeah, because, now that my kids are getting older and they're going to start leaving, and I keep saying the older I get, the bigger my backyard seems to get because of all the maintenance.
Yep. Yep.
Wow, interesting. So this is nothing new.
No.
It's just that we're in an interest rate environment, a very unprecedented home buyer's market and selling market. How does one navigate through this the best way if they're even thinking about selling or buying, Danielle?
Well, I'm always going to say that getting your financial ducks in a row is the most important place to start.
Get that checkup with your loan officer.
Sit down with a loan officer, work with a solid advisor, understand what's going on, and I would tell you to be careful what you read on the internet.
Yeah,
okay?
Yeah.
And then get working with a professional full-time real estate agent that's going to help you understand the market.
Yeah.
Nobody can tell you if it's the right time for you to buy or not. Don't be scared about the interest rates. Look at where your future's going. And if this is the right time for you, new household formation is always the biggest predictor of what's going to happen in the real estate market. And we've talked about, if 37% of first-time home buyers are in the market, this millennial generation, we're still in the middle of a 9-year cycle where there's going to be more and more millennials hitting that 30-year-old age range. We've got about 4 years left, 4 to 4.5 years left of that. So
and it's not just going to turn off; it's just going to start to trend down.
No, and the baby boomers aren't leaving their homes,
right?
Which
we're living forever.
We've talked about that, but we're seeing it in the statistics,
right?
That if the baby boomers aren't leaving, right? I mean, and even if you are, let's say you are a baby boomer and you're retiring or you're retiring soon. Think about those things now. It doesn't ever hurt. First of all, you should be talking to your financial advisor, right? If you're within a few years of retirement, talk to your loan officer. Talk about where you want to go, what your dreams are, what your aspirations are. Is it a condo? Is it Florida? Moving to Tennessee, Kentucky, with someplace better, right? Whatever your plans are, your dreams are, come up with a roadmap. I don't mind taking calls from people that say, I think I'm going to do this in the next 6 to 12 months. Great, let's talk about it. And so that you understand what your options are and what the pluses and minuses are and how to come up with the roadmap. Don't be afraid of the interest rates. What I've been telling everybody for all year is that I promise you, if you buy now, 2 things. You're going to call me in 6 months to a year and say, I'm glad I bought. Look at what my house is worth today. And boy, did I get a good interest rate.
Yep. Yeah. You talked about a couple different sandboxes. You talked about a professional real estate agent. You talked about a financial planner. We've brought up about accountants. You brought up about utilizing a certified mortgage advisor. These are all teammates.
Yeah.
And many times we love to work with the client's financial planner, their accountant, and of course we work with their agent because we are all a team. And because we all have our specialties. We know mortgage and finance. The financial advisor, he understands stocks and portfolios. That real estate agent, they understand the market. And when we all come together as a team, gives you the best and highest probability of creating a very successful, well-balanced plan.
Well, I have a client right now that I have pre-approved, and he is going to... They're newly married or almost an engaged couple. The woman already sold her house. The man has a house to sell, and they're going to buy a house together. Blended household, get married next year, right? All this exciting stuff. Well, he has questions about capital gains, how that works, because he has not lived in his home for 2 years yet. And he started asking me all these questions. And I said, well, sir, I'm not a CPA. I'll tell you what I know, but you need to contact a CPA. Well, here's the other problem I find in this day and age. He does his own taxes.
Oh, yeah. Yep.
Through an online tax preparing service.
Trying to save a couple $100.
Right. Okay. But he has no one that he can go to and ask this question of right now. And I helped him out the best I could, but I have to say I'm not a CPA, and it's still tax season.
Well,
so to get a CPA that you don't have a relationship to answer the phone and give you free advice is going to be kind of difficult.
Well, that's kind of like a self-diagnosis. I think I got cancer. I'm going to start just cutting away in here and finding out what's going on instead of going to get
Let's go to WebMD and figure out what's going on.
Getting a professional on your team.
Yes. Yeah. Wow. Yeah. So, there is that. I think that would be my biggest advice. If you're a potential first-time home buyer, you need to assemble your team. Yeah. Because you're not going to find all the answers on the internet. Like I had one of my clients that is pre-approved. They're trying to buy 3% down conventional. And the wife called and said, well, why aren't we qualified for the rates that we're seeing on the internet? Well, you don't have a 740 credit score and you're not putting 20% down.
Did you?
And they don't read the fine print about what the costs are associated with that, magical interest rate that somebody's showing out there.
Did you know the magic formula for advertising is get the phone to ring? And of course, they're going to just give some low ball rate. And but then you may end up talking to a fast food phone jockey who was selling ice cream yesterday.
Exactly. Not going to give you any good advice.
Yep. It says, close. Here, I'll just, they do what's on their best interest or not taken into consideration.
Or what they were told that they need to sell that day.
Yeah. Remember, my wife always says, she goes, God, sales is so easy. You never sell, you teach, you educate, and sales take care of themselves. Very interesting. So anyway, that is our statistics, I guess, portion here. Very interesting. So the market's going to stay alive. But for any of you out there who are listening, get your team together. Give us a call. Whether you're working with another lone individual or not, we would love to get you a second opinion on your situation. Any closing words, Danielle?
Well, you don't know what you don't know.
Yeah, you don't know what you don't know until you give us a call, and we'll tell you exactly what we got. But anyway, that is Danielle Boote. My name is Victor Bals, and It's been fun today, very interesting, and we will see you next time on A Smarter Way Home.